Alright, for this video I want to go over a sample form 990PF for a non-operating private foundation. So the 990PF can be filed for non-operating foundations, operating private foundations, and certain types of trusts. So in this example we're specifically going to be looking at a non-operating foundation, and that's important because it determines what parts of the return you actually have to complete, right? Operating foundations, you have to do generally a little bit more work. So in our case here, we have a non-operating foundation, so we'll go through the sample 990PF for that type of scenario. And then we also have a set of financial statements here for our foundation, so a statement of activities for the short period that it was open during the year, and then a balance sheet at the end of the year. And then we do have a reconciliation here, which shows how we're allocating income and expense across our net investment income and then charitable disbursements. So we'll come back to this in a little bit later. And then we have a monthly reconciliation here, which we need to compute our minimum investment return. So when we get to that part of the 990, we'll come back to this as well. And then lastly, just have two slides here, one covering the summary of what we're going to look at, and then the other one detailing the fact pattern, and then some key points to remember. So start with the slides, and then we'll get into the return here. So again, we're doing a 990PF for a newly formed non-operating foundation, also referred to as grant-making foundations. And that's because the foundation itself doesn't conduct its own charitable initiatives, right? What it does is it collects contributions from a donor or donors, and then it disperses those payments to other public charities, right? So we've got the financial statements. We'll look at that. We'll do all the pages 1 through 13. Schedule B is going to be required because we have the donor contributing the cash during the year, and then we have some supplemental statements and schedules that are also necessary. And then we'll talk about allocation of expenses and those taxes on the investment income. So let's start with the fact pattern here. Do have some notes to remember down here. So these are some of the key issues. Private foundations obviously have a lot more moving parts, and there's other things to kind of be mindful of. I'll talk about those as we go through the return, but I've only highlighted here some of the big ticket items. All right. So the fact pattern we have here, we have an individual, John taxpayer. He's a Florida resident and decides to open a private non-operating foundation. So John hires an attorney to set up the entity and submit the tax-exempt application. That's the Form 1023 to the IRS. So the IRS approves the tax-exempt status as a non-operating foundation. Foundation goes ahead and opens a checking account, brokerage account, and John puts $100,000 in cash into the foundation. So that's John's charitable contribution. The foundation paid an investment manager $900 in fees to manage portfolio during the year, and the foundation did reimburse John $2,000 for the legal fees that he prepaid in advance to get the Form 1023, set up the foundation itself, right? So those are the legal fees. The foundation distributed $3,000 of charitable donations to a local nonprofit. So there was a $3,000 donation there. And then by the end of the year, the foundation also pledged to donate $1,500 to a different nonprofit, but it didn't actually pay it yet until after the close of the year. And so that'll be important when we look at grants payable and how that's reported on the 990PF. So the tax return was extended, so they didn't file before the original deadline, they filed before the extended deadline, and with the extension they made a $50 tax payment with that request, and that was based on their estimate of what they think they might owe on that net investment income. So non-operating private foundations, some of the basics here. These are private foundations that are not tax exempt. So they have to pay income tax on their net investment income. They don't pay income tax on the donations, right? So the donations that come into the foundation are not subject to income taxes, but they do pay this tax on the net investment income, which is their gross investment income less an allocation of those expenses attributed to the gross investment income. So the other big ticket item here to remember are the minimum investment returns and what is your distributable amount for the year. So non-operating foundations, in order to maintain their good standing, they have to make eligible charitable expenditures during the year. And charitable expenditures includes grants and an allocation of the foundation's expenses, right? And so we'll look at that in more detail later, but effectively your charitable expenditures include the money you actually send out to other charities, plus you can allocate a portion of your expenses to that total, all right? Now the amount that you have to send out is equal to or exceeding about 5% of your foundation's assets. And I say about 5 because you'll see with the calculation later that we're taking averages of each month, so you can't really pin it down on one date that you would value your assets. So the failure to meet this requirement is quite stiff, right? So you pay a 30% penalty on the shortfall. So if you don't meet your distributable amount for the period, you would pay a 30% penalty on the amount that you did not distribute that you should have. And as far as timing here, the foundations have 12 months from the end of the tax year to send out those distributable amounts. So there's basically a 1-year lag. And that's important because for first-year foundations, which is this one, the first-year foundation technically doesn't have a distribution requirement, right? Because you calculate what you have to distribute at the end of the year, and then that amount has to be paid out in the second year. Now, in practice, what we do see is foundations will make distributions in their first year, and that's what we're going to see in this example. But that's something to just remember is that the distributable amount is actually a 12-month lag on it. So you don't have to basically guess or see into the future as to what your distributable amount will be. You just have to know that, okay, whatever I calculate at the end of the year, that's what I've got to be paid out by the end of next year. Now, different distribution rules for funds in their startup period. So when the private foundation is in its first 4 years of existence, it's in the startup period where it actually gets reduced distribution amounts. But then after that, you're in your full payment period, so you got to make the 5% payment each year, or else you have this 30% penalty issue. Now, allocating expenses, this is very important, right? So allocating expenses between your net income, net investment income, and charitable disbursements. So your deductions allocable to net investment income include all ordinary and necessary expenses paid or incurred for the production or collection of that income. And it can also include a portion of your operating expenses, right? So an allocation of operating expenses that you deem are attributed to that production or collection of gross income. And then the same goes for the charitable disbursements, right? So any amount, including that portion of reasonable and necessary admin paid to accomplish those charitable purposes as defined in Section 170C 2B. So 170C 2B is that definition of what it means to be a charitable contribution, right? So organized and operated exclusively for religious, scientific, charitable purposes, and so on. All right, so let's have a look at the financial statements really quick, and then we'll start getting into the return. So we've got our foundations statement, financial statements here. We can see here at the very top, the contributions or gift received. There's the $100,000 that John put into the foundation, right? So that's going to be his charitable deduction for the year on his 1040, subject to that 30% limitation of AGI, right? We could talk about that a little bit later as well. So remember, the foundation opened a brokerage account, so it invested in some publicly traded securities. So they've got some interest income, dividends, and capital gains realized on the stocks. And then in their expenses, we've got legal fees, accounting fees, some office expenses, filing fees, and then there's the investment management fees of $900. Now, grants and contributions paid, the $4,500, that is the $3,000 that was actually paid during the year, and then that $1,500 grant payable. So these financial statements are prepared on accrual basis, and so we have the grant payable there. That's showing, okay, this is what's pledged, this is what we're recording on our statement of activities, but we haven't actually paid that at the end of the year. And this is really important because these are going to be separately stated on the 990 PF, right? They're separately stated, and the $3,000 that was actually paid, that's the only piece that is treated as paid and applied against that minimum distributable amount. And so we'll look at that a little bit later as well. And then the unrealized gain loss on investments. So the stocks on the balance sheet are reported at fair market value. So meaning whatever the cost basis is up until or down, whether they appreciate or depreciated, you'll have an unrealized gain loss on our investment. And so our total change in assets here is $99,919. And so we can see this has been contributed without donor restriction. And then the rest of the balance sheet is pretty straightforward, right? Grants payable, balance in the cash accounts, and then our stocks, fair market value amounts at the end of the year. Now, if you kept your financial statements not just on a cost basis, so stocks at cost, then you wouldn't have an unrealized gain or loss amount. But otherwise, it would be mostly the same for the most part. Okay. Now, the reconciliation here, very important. So let me look at page 1 first to start with, and then we'll go back and forth between part 1 and then the Excel workbook, and you see what's happening here. So 990 PF at the top, we've got the name of the foundation, the EIN. Because this is not a full calendar year, it's a short year because the fund wasn't set up until February 19th. We had the period Feb 19 till December 31st, 2022. The EIN for the foundation, contact address, and marking it as an initial return. Now, it is a 501c3 exempt private foundation. So the 4947A1, those are trusts set up for charitable purposes that could file a 990 PF in lieu of a 1041. That doesn't apply here, right? We've got a 501c3 exempt organization. Accrual method is the accounting method we're using, and then the F&V of all the assets. This is pulling from the balance sheet. We'll look at that when we get to page 2, but that is the fair market value of all the assets at the end of the year. All right. Now, part 1, analysis of revenue and expenses, and then the different columns. So revenue and expenses per books, this should, for the most part, match your revenue and expenses per books. Here's the one difference, depending on what kind of accounting methods you're using. So the revenue expenses per books, after we enter our revenue items, right, the expenses, you'll note down here the excess of revenue or expenses is $94,864. But on our financial statements, we're at $99,919, and that's because we have the unrealized gain or loss on investments recorded in our books. The instructions don't want you to record unrealized gain losses in column A. That amount is going to be separately stated when you get to part 3 for the change in net assets. So we'll talk about this more detail when we get to it, but that's why the initial reconciliation here doesn't match. And that's okay because, again, the instructions don't want you to report the unrealized amounts in column A. You separately report that in the change in net assets. So we have our revenue and expenses per books, and then now we are categorizing them as appropriately between columns B, C, or D. Now, column C, the adjusted net income column, you'll notice this is totally blank, and that's okay for non-operating foundations. So column C is generally only used when you have a private operating foundation. Non-operating foundations aren't going to need this column unless you are actually engaged in some limited operating activity during the year. So if you had a very small project where you earned some exempt function income and then you had some expenses, you can report it there. Or if you're a non-operating foundation that has a common fund, but frankly, in practice, we just don't see that. You're going to have a non-operating foundation with nothing entered in column C. Now, column B is where we report our gross net investment income and then the allocation of those expenses. So net investment income, we've got our interest, our dividends, our net capital gains here. We do have to report the gross sale price of capital gains that were gross sale price of all assets. So whether it was gains or losses, whatever the gross proceeds are, that amount gets reported there. And so there is a separate part within the 990 PF where we report the capital gains and losses. And so these net amounts are being reported here. But we will get a look at that part later on when we get to it. Actually, we could just jump to it really quickly here just so you can see where we're pulling those numbers from. So in Part 4 is where you would report capital gains and losses on the sale of those investment assets. So we sold some Apple stock, some Google stock. So we date acquired, date sold, how we acquired the property. So we did it by purchasing it because remember, John put cash in and then the foundation used the cash to buy the stock. In contrast, you'd often have donors just contribute actual non-cash property, so they might donate the stock itself. And so if you received stock itself and you didn't purchase it directly within the foundation, then you would have D for donation as the method of acquired. So that's how we arrived at our net $845 a gain. And so that's why it's being reported up here, revenue expenses per books and the net investment income allocation. Now, allocation of the expenses. So again, we have the totals here in the column A for net income or revenue and expenses per books. So we can see the legal fees, the accounting fees. And under the other professional fees, we have our $900 of investment management fees. And then the other expenses down there on line 23. So with charitable disbursements and net investment income allocations, let me go to this reconciliation here. So for our net investment income, you are only allocating expenses that are directly related to the net investment income, and then a portion of your expenses per books that you deemed can be appropriately allocated to these earnings. So you notice here that the investment management fees, we're allocating all of it to net investment income, and then none of it's going to charity or being allocated for charitable purposes. And that's really common, right? That's often what you see because it would be a real stretch to argue that, well, we're paying this portfolio manager to manage the investment assets. And yeah, we could argue that maybe a portion of it is related to charitable purposes. It's just not, right? It's very clearly only related to the net investment income piece, and so that's why all 900 is being allocated to net investment income. The accounting fees, the accountant in this example does spend some time reconciling the income, right? So they look at the statements, they make the fair market value adjustments. So we could argue that a portion of the accounting fees is attributed to net investment income. And we have such here. We've allocated 25% to net investment income. The remainder is being allocated to charity. But all the other amounts, the legal fees, the office expenditures, filing fees, really none of that is traceable, even on an allocable basis, to the net investment income. So they're just going to charity. All right. Now, why is this important? Well, you'll see this later on when we get to these parts. But this is important because the more expenses you allocate to net investment income, the lower that total is, and so the less amount of tax you'll pay. So if you have more net investment income expenses, you pay a lower amount of that 1.39% net investment income tax. On the charitable disbursement side, the more fees or expenses you have allocated to charity, the more you're covered as far as meeting that minimum distributable amount. Right. So, on disbursements for charitable purposes, you can certainly get there by actually cutting checks to charities. But you could also get there by just allocating more of your expenses to disbursements for charitable purposes. So that's why you got to be very careful with these allocations and make them reasonable, because you don't want to come up with something that's abusive and that you're overstating your expenses in one column or the other to try to meet that minimum distributable amount, or trying to lower the amount of taxes that you'll pay on your investment income. All right, so that covers our net investment income column. So we've got the 188 allocating accounting fees, the other professional fees of 900. So the total expenses is 1,088, and the net investment income for the year is $2,531. So this is going to be the amount that is going to be subject to that 1.39% tax. Now, column C, again, we're skipping over this because we have a non-operating foundation. So we move on to column D, again, disbursements for charitable purposes. We've got our legal fees allocated here, accounting, and then our other admin expenses, right, the filing fees, and then those office expenses. And then on line 25, contributions, gifts, and grants paid. So the amount that we had booked per books was $4,500, right? That's the $3,000 that was actually paid out during the year, and then the $1,500 grant payable. For the column D, disbursements for charitable purposes, this is cash basis only. So the only amount that we can include in this column for the grants is the $3,000. It's the actual amount paid. The $1,500 cannot be included in this amount because it wasn't paid until 2023. All right. So the total expenses and disbursements, we got $6,167. So that is going to be the piece that is applied to our minimum distributable amount. All right. Now, if we move on to part 2, balance sheet. So beginning of the year, this is an initial year return, so we're not going to have any values. So we just have end of the year values, book value, and end of the year FMV. So if we have a look back at our financial statements here, you can see that our statement of financial position is expressed using fair market value numbers, right? So the stocks, we're not listing them at cost basis, we're listing them at FMV. So that's why you see here there's no difference between on 10B for those investments in corporate stocks. We have the $91,055 matches the fair market value. If you don't keep your books using this method, you would likely have just the cost basis of the investments, but then you still are required to report the FMV of the amounts. So in our case, again, they're the same because we are marking to market effectively for book purposes what the fair values are. Grants payable, there's the $1,500 that we owe that nonprofit at the end of the year. And then our net assets without donor restrictions, $99,919, which reconciles with our financial statements here, right? We don't have any net assets with donor restrictions because when John put the money in, he wanted it categorized as such, right? Just for general support without any donor restrictions. Now, what about foundations that don't follow FASB ASC 958? So the private foundations don't have to follow this standard for the most part. If you do follow this standard, you do track your net assets differently, right? With and without restrictions. There are a few other adjustments you have to make to your financial statements. But instead, if you don't, you could mark this box is that you will not follow ASC 958. And at that point, you just treat it almost kind of like just a regular corporation, right? You have the amount of principal put into the foundation, and then any retained earnings would be a roll forward of the excess of your income over your expenses. Okay. All right. Part 3, analysis of change in net assets. So total net assets at the start of the year is 0, right? Because this is an initial year return. So the net income or loss per books coming from page 1. So part 1, line 27A, right? So there's our 94,864 figure. So we got the 94,864. And then this is where you would enter those unrealized gain loss adjustments on securities. So in our case, because we do make those adjustments for our financial statements, we have the unrealized gains of $5,055. And so that increases our total net assets at the end of the year to $99,919, right? And then this reconciles, it does, ask you to do a check figure here, part 2, column B, line 29, right? So this is part 2, column B, line 29, $99,919. So these should reconcile, right? So this should match. If they don't, you've done something wrong. All right, so part 4, we've covered this, the capital gains and losses for our taxes on investment income. So we reported the sale of the stock there. Now moving on to the excise tax, right? So the excise tax based on investment income, if you have an operating foundation, you are exempt from this tax so long as you distribute enough to charities, right, in the form of grants. In this case, we are a non-operating foundation, so we are subject to that 1.39% tax. So we can see here all other domestic foundations enter 1.39% of line 27B. Right, so if I go back up here to line 27B, we had part 1, column B, line 27B, right? So 27B, net investment income, $2,531. And we move on down here so we can see the tax. Sorry, let me get my calculator out here so we can see the math. Right, so we have the, what was it, 2,531. 2,531 times 1.39% gives us a $35 tax. All right. Now we can see on line 6C, remember in the fact pattern, we filed an extension and we submitted a payment with the extension. So here we've recorded the $50 that we paid with the extension request. So the net amount of tax based on investment income that we get refunded, right? We get a $15 refund because we overpaid. In our case, we're not going to ask for a check back. We're just going to have it credited to our 2023 estimated tax payment. And that's also quite common. The charities try to get it pretty accurate, and then to the extent you get any excess, you just tell the IRS to keep it, right? So just roll it forward to next year, and then always make sure that you do have enough paid in to try to avoid any kind of underpayment penalty. All right, so Part 6A, statement regarding activities. So now is when we get into a lot of questions about activities of the foundation, who are the substantial contributors, disqualified persons. The objective here is to honestly try to keep you honest with all these questions. So private foundations, charitable trusts, there are a lot of things you can't do, otherwise you're subject to penalty or just flat out shutting down the foundation. So you want to read each question carefully, check whether or not it applies. If so, answer appropriately and then do the next steps, right? If you have to attach additional disclosures, additional returns, then go ahead and do it. So I'll go through, a couple of these just to illustrate the point. So, 1A, it's asking us, do we attempt to influence any national, state, or local legislation or participate in a political campaign? In our case, no, right? This really is just a foundation that was set up that's going to support a few local nonprofits. It's not engaged in any of these kind of activities, right? So we didn't spend more than $100 during the year for political purposes. All right, a big one to keep track of is the UBTI, so unrelated business gross income. So if the foundation has UBI of 1,000 or more, it should certainly answer yes, and then it likely has to file a 990T because the private foundations might be exempt from income tax and only subject to that 1.39% on net investment income. But if you have unrelated business income flowing through from, let's say, a partnership investment, that is going to be subject to regular income taxes. All right. Question 8A. Enter the stage to which the foundation reports or with which it is registered. So we're set up in Florida. We did furnish a copy of the 990PF to the appropriate agency in Florida, right? So we've marked that 8B as a yes. Question 9, is the foundation claiming status as a private operating foundation? And no, right? We are a non-operating foundation. We have not taken the position that we are an operating one. Question 10, did any persons become substantial contributors? Yes. So John contributed more than $5,000 during the year. So he hit that. He hit that mark of a substantial contributor, and so we're going to have to disclose that information on the return in a separate statement. And just to expand on this substantial contributor definition, it's a bit obscure, but effectively it's any person that put in during the current year and all the prior years more than $5,000, and they account for more than 2% of the total across all the donations, right? So in our case, John is the only contributor, and he certainly put in more than $5,000, and it's the first year. So he definitely meets that definition. But don't think of it as simply as anybody that puts in more than $5,000 is automatically a substantial contributor. Might not necessarily be the case. So have to look at that a little more closely. So question 11, no controlled entities. Question 12, we didn't make any distributions to donor advised funds. Inspection requirements, right? So we have made this information public. So John created, his own foundation website, and he's appropriately listed a contact address, so he's compliant on that front. Question 16, foreign bank accounts. No, we only have local accounts. Okay, so Part 6B, statements regarding activities for which Form 4720 may be required. So this section is where we dip into almost more of kind of the penalty section, depending on the activities of the foundation. So we're talking about things like self-dealing issues and excess business holdings. So questions 1A, during the year, did the foundation either directly or indirectly engage in sales or exchanges with disqualified persons? So disqualified persons is quite a broad range of persons or companies, right? It's any substantial contributor, right? So we just touched on that. It's any foundation manager. It's persons that own more than 20% of a company that is also a contributor to the foundation. It's family members of any of these people. So it's quite a long list of this, who is a disqualified person. But in this case, we can answer no to all of them except for 1A4, right? And so 1A4 is asking us, did we during the year pay compensation to or reimburse expenses of a disqualified person? And so in this case, John is certainly a disqualified person. And so although he didn't take any kind of compensation from the entity, he was reimbursed for advancing those legal fees. And so this is one of those scenarios where I think it's appropriate to disclose that, yes, that transaction did occur. But the other thing that you can remember is that most of the time, these will mean an exception to where it's not penalizing. So when you get down to 1B, it asks, well, if we answer yes to any of these 1A through 1.6, did any of these acts fail to qualify under the exceptions described under the regulations? And so in our case, these would make an exception for those rules. Another one is a common exception is if you do pay disqualified persons like a reasonable wage to manage the foundation. In this case, John's not taking one, but if he was paid a reasonable wage, you can meet an exception as long as it was, third party, an arm's length third party relationship. It's not too much, too little, then it would be okay. And that is very often the case with larger foundations that have foundation managers, right? So foundation managers are officers, directors, and the like, and so they often do get paid something. And so that's where you would have a question answered yes for line 1A4. All right, so some other big ones down here. Failure to distribute income, right? So taxes for failure to distribute sufficient amount of income doesn't apply to us. We don't have any undistributed income because this is a first year, right? So we don't have any undistributed income from prior years. Another big one, excess business holdings, right? So 3A and 3B. Excess business holdings, always think of that as kind of foundations buying closely held stock, where the substantial contributor here, the disqualified person, is also a shareholder. That's where you could have those kind of issues. But in our case here, John only invested in publicly traded stocks, so there weren't any issues there. Or the foundation only invested in publicly traded stocks. Okay. This is worth touching on too. So investments that jeopardize charitable purpose. So think of this as kind of the prudent investor rule. So foundations have to invest the principal reasonably, right, as a prudent investor. Or you can't make risky investments. And the idea is if you make a risky investment and the portfolio value collapses, then the charity has no funds or the foundation has no funds available to fund other charitable purposes, right? So by making incredibly risky investments, you're not doing the foundation the fair service that needs to be able to fund these initiatives. So when they ask, did you make something that jeopardized charitable purposes, that's really kind of what they're after, is have you made really risky or stupid investments that could effectively bankrupt the foundation. Okay, second part of Part 6B, right, more legislation and politics questions, right? So did we carry on any propaganda or influence legislation, provide influence the outcome of any public elections, provide grants to individuals for travel, study, or other similar purposes, right? So none of these apply to us. The last catch-all here, right? Provide for any purpose other than religious, charitable, scientific, literary, or educational purposes. No, right? And then 5B is asking, well, if we answer yes to any of these, did we meet exceptions? Well, we answered no to none of them, so that's why we left that one blank. Personal benefit contracts is another big one. No, we didn't receive any amounts, nor did we pay the premiums for them. So those are all no's. And then did we participate in any tax shelter transactions? No, right? Again, this is a very, very simple non-operating foundation. All it did was buy some publicly traded securities. It hasn't done anything tricky here. Part 7, information about officers, directors, trustees, foundation managers, highly paid employees, and contractors. So lists all of these individuals and their compensation, right? So any officers, directors, trustees, foundation managers. John is the only one affiliated with this company as of now. So he's a director, he works an hour a week, and he wasn't taking a salary, right? So he wasn't paid anything. Now, the highest paid employees, and then when we get into highest paid contractors as well, on the next pages, we don't have any employees, right? And again, you only have to disclose it if you paid the employee more than $50K. So we have no high paid employees, we don't have any employees at all. More information about the independent contractors. So list the 5 highest paid independent contractors for professional services, and list each person paid more than $50,000. Now, person is an individual or a company. So if you paid legal fees of $75,000, put down the lawyer here, right? What's the law firm, type of service, and the amount you paid them. In our case here, we did have some independent contractor payments, but nothing amounted to more than $50,000. All right, Part 8A and Part 8B, direct charitable activities and program-related investments. So non-operating foundations, this is often going to be not applicable, right? Operating foundations actually are engaged in direct charitable activities, right? So if you're engaged in direct charitable activities, you would have entries here, but in our case, we're a non-operating foundation, so we just distributed amounts to charities that are actually involved in direct charitable activities. And the same goes for the program-related investments for operating private foundations. To the extent you have made investments where you're earning a return on them, then you would list that information here. Okay, so Part 9 and Part 10. Minimum investment return and the distributable amount. So the minimum investment return, this is where we are calculating, right, the amount, the starting point as far as what has to actually be distributed out to the charities, right? So again, that's the grants plus the allocation of the expenses. So we calculate this based on the asset values on an average basis within the foundation, and then we have a carve out for a portion of the cash that can be deemed directly held for charitable activities, and then we calculate that minimum investment return. So 1A and 1B, the average monthly values of our securities, and then the average of the monthly cash balances. So how do we calculate those amounts? So we've got in our Excel workbook here, we have listed the monthly balances for cash and stocks at the start and then end of the month. So when the month started, right, when the cash was put into the foundation, we had $100,000. And then at the end of February, we had $98,500. Stocks was just 0, and that's because they hadn't actually funded the brokerage account yet. So then we've got the balances at these dates, fair values for cash and fair values for stock. Now I have a separate one for the cash because the cash is kind of unique in that stocks you can just average it based on what the fair value is at the end of the month. With cash, you're supposed to use the averages of each month. So you take the beginning of month balance, the end of the month balance, average it, and then do that for each month, and then take the average. So for example, if we look at like March, you're supposed to take, what's the balance at the start, what's the balance at the end, then average it, and you do that for each month. And so that's why, it's almost a little bit more of a complex calculation, but nothing too extreme. It's just it's one additional step apart from the stock valuations. Now, what's important also to remember is that those are the methods for these types of assets. But if you have other assets, the valuations and the dates you use can be different, right? So for some assets, you just take the valuation at the end of the year. And you can or if you have a fixed asset and you get a valuation report, often you can use that for a couple of years before you have to get a new one. So in this example, all we have is cash and the fair market value securities. So we don't have to worry about the fair market values of any other kind of obscure assets. So we enter those totals, right? We've got our total here on line 1D. We don't have any acquisition indebtedness, so this would be, have we purchased any securities, or basically are we trading on margin, right? That's a big one. Have you borrowed any money to invest in securities? In our case, no, right? So that's why that's 0. Now, the 1.5% carve out. So you are allowed to kind of exclude 1.5% that is attributed. Basically deemed held directly for charitable activities. So 1.5% of that amount doesn't have to get included in this minimum investment return calculation. So the minimum investment return, not the minimum investment return, the cash deemed held for charitable purposes is 1.5% of line 3. So 103,591 times 1.5% is 1554. And then so our net value of non-charitable use assets is 102,037. Now, the minimum investment return, you see here that it's asking us to use 5% of line 5. But the 4417 isn't 5% of line 5. When you have a short year, you are allowed to prorate it. So the start of the year here was February 19th, end of the year was 12/31. So we have 315 days in a 365-day total for the year. So the prorated percentage is 86.3% of 5%. So if we actually use the 5% number, the minimum investment return before we subtracted out those taxes would be $5,102. But because we had a short year, we can use the reduced prorated percentage of 4.32%, which gives us 4417. So that's why for the first year, you'll want to use the reduced prorated percentage, not the full 5%. So once you have the 4417, then you can further reduce it by the taxes that you have on the investment income. So remember, we already calculated the $35 in taxes on our investment income, so we can subtract 4417 minus 35, and the distributable amount is going to be $4,382. So this is going to be, think of this as kind of that minimum amount. So it's the grants and the allocation of expenses that has to be paid out in order to meet that minimum distribution. To avoid that excise tax, right? We want to avoid that 30% penalty. So now moving on to part 11 for qualifying distributions, amounts paid, including those admin expenses to accomplish charitable purposes. So the expenses, contributions, gifts from part 1, column D, line 26. All right. So part 1, column D, line 26 is 6167. So there's our $6,167. None of these amounts apply to us because again, we don't have any program-related investments. We didn't. Line 2, we're not engaged in directly carrying out charitable activities, right? We are a grant-making foundation, so we're not an operating foundation, so none of that applies. So our total qualifying distributions remains at $6,167. All right, now so Part 12, Undistributed Income. So the top right-hand starting point here, 2022 is the column we're working with. 4,382 is our distributable amount for 2022. So that's the amount coming up here from Part 10. So Part 10's 4,382 is line 1, column D. And because this is a initial year return, we're not going to have any entries for 2021, so the year prior, or the total amounts from years prior to 2021. So as you can see here in B and C, these are completely blank. And then obviously, anywhere you see it completely grayed out, it means that there'd be no circumstance where there would be an entry there anyway. So you're only working with the light, the non-shaded boxes here. So the excess distribution carryovers, right? If we had distributions that exceeded our minimum distributable amount, then we would have some carryover that we can apply to 2022. But again, because we don't have any excess distributions, we're not going to have any amounts in Section 3. The qualifying distributions, right? So question 4, qualifying distributions for 2022, Part 11, line 4, there's our $6,167. And then in 4D, we're asking ourselves, okay, of the totals that we've got here, right, how much is being applied to our 2022 distributable amount? Well, we had 6167 to work with, but the minimum was only 4382. So we're going to take 4382 out of this, apply it to our 2022 minimum distributable amount, which leaves us a remainder of 1785. So 1785 was effectively the excess amount that we can carry over to future tax years. So when everything is said and done, line 9 here, excess distributions carried over to 2023, and then we've marked it as the excess from 2022. So the 1785 is going to be rolled forward to next year, right? And we'll see it up here on next year's return. And so that can be applied to next year's minimum distributable amount. Okay. All right. So Part 13, private operating foundations. We have a non-operating foundation, so we can leave this section blank. In Part 14, supplemental information, only needed if the foundation had $5,000 or more in assets at any time during the year. In our case, we do, right? So we've got a little around $100,000 in assets. And so we have to report information on the foundation managers. So we've listed managers of the foundation who have contributed more than 2% of the total contributions before the close of the tax year, but only if it was more than $5,000. So John Taxpayer certainly meets that standard. And then, do we have any managers who own 10% or more of the stock of a corporation of which the foundation has a 10% or greater interest? And the answer is no, right? The foundation is invested in publicly traded securities, so they don't meet this 10% stock threshold. And John Taxpayer doesn't have any affiliation with any of those publicly traded securities. Question 2. So in our case here, the foundation only makes contributions to pre-selected organizations. So John just kind of determines who he wants to distribute the grants to. So he doesn't make, or he doesn't open up the foundation to requests for funds, right? So if you did, right, if you did have, let's say on the website, there was a button that said, hey, click here, email us if you want us to consider issuing you a grant, then you have to provide that information down here. And in John's case, he doesn't do that. Okay, so Part 14 information on the grants actually paid during the year, and then information on those grants payable. So remember, we made an actual distribution of $3,000 to one charity, and then we had a grant payable at the end of the year for $1,500. So the recipient here, John paid this $3,000 to a non-profit hospital. The foundation status of the recipient, PC, stands for public charity. And then the purpose of the grant or contribution, you want to be as descriptive here as possible, but if you just contribute funds, as this states, right, for general operating support, you can put that. So John stated for general operating support, and then the amount for $3,000. And again, these are the amounts that were actually paid or approved for future payment during the year. Sorry, these are the amounts that were actually paid during the year, and then the ones that are approved for future payment are down here in section B. So the amount that he wanted to pay to this nonprofit for the fire department, listed down here, $1,500, again, is for general operating support, but it is not been paid yet. It is recorded as a grant payable at the end of the year. Okay, so part 15A. This section is required, but it's really important if you have any kind of unrelated business income. So the idea here is they're trying to figure out, well, if you have unrelated business income, what portion of it is subject to tax? If you have income that is investment income or other kind of program service revenue or other revenue, if it's exempt from unrelated business income, why? And so we have, if you have any UBI, you would report it in columns A and B. But most of the time, what you're going to see looks very similar to this for non-operating foundations, right? You'll have the investment income and then the appropriate exclusion code. So the exclusion codes, there's a table in the 990 PF instructions that will show you, depending on the type of income, what code you should enter. For interest and dividend income, it's code 14. For gain or loss on sale of investments, right, it's code 18. If you had a operating foundation, then you would see items reported in column E, but non-operating foundations, you generally are not going to see anything here. But UBI could happen to both. So depending on the type of investments you make, we often see it come because you're invested in a pass-through entity. So you get a K1 from a partnership. You might have some unrelated business income. And then to the extent you do have anything in column E, you have to detail that the relationship of that activity to the exempt purpose, right? So you've got to describe, well, if we had some program service revenue here because we were actually doing some charitable activities other than making grants, explain how that's related to your foundation, right? Okay, now moving on to part 16. So transfers to and transactions with non-charitable exempt organizations. So when would you see something like this? So if you have, there are a lot of organizations that are 501c3 orgs. So they are, that are 501c organizations that are tax exempt, but they're not charitable. So an example would be fraternities or sororities. Those types of organizations are 501c8 or 501c10 organizations generally. And so they are tax exempt, right? They file a 990, they don't pay taxes, but they're not charitable. And so if you have any transactions with organizations like that, you've got to answer these questions appropriately and provide more information on the transfers. In our case, we only transferred grants to public charities that are 501c3 organizations, and in 527 we didn't make any transfers to political organizations. Now you should separate them based on relationship. So if it's truly a third-party relationship, then you can list them here in this section. But if they are directly or indirectly affiliated with you, then you would have to enter that information down here under 2B. Okay. All right, so that covers all the main parts. So now on to Schedule B. So Schedule B is that schedule of contributors. So we were filing a 990 PF. We are a 501c3 exempt private foundation. And then we are checking the general rule box, right? None of these special rules apply to us. So we are listing all those contributors that paid $5,000 or more during the year, and that's cash, non-cash property, and if there were any payroll contributions. So if we move on to the schedule of contributors here, part 1, we can see we've got John, taxpayer here, his address, the total contributions, and then we've checked the person box. So type of contribution, if cash is paid by an individual, so a person or a company, they're the ones making the contribution, then you check the person box. Payroll would happen if a company had an employee and the employee said, oh, I want $100 taken out of my paycheck every week, and then you have to funnel it to this private foundation or this charity. That would be a payroll contribution. And then non-cash is non-cash, right? If you contribute property like stocks, bonds, real estate, any of those types of assets, that would be a non-cash contribution. In our case here, very straightforward. It's just John, taxpayer, contributing cash. So we've checked the person box. Okay, supplemental information. So recall in Part 6A, it asks us to list the substantial contributors. And so we've got John, taxpayer's information listed there. The change in net assets, right? We've got that unrealized gain loss on investments detail, just to let them know that is the reason for that adjustment. And then the investments in the corporate stock. So if we look at the balance sheet here, in 10B and 10A and 10C also, it asks us, okay, you have investments in corporate stock, attach a schedule providing sufficient detail. And so that's what we've done here. Is you shouldn't just say, oh, I have $91,000 in publicly traded stock. You have to list each entity that you're invested in, right? And so, John, the 990 PF here is listed out each publicly traded investment. So we've got a Vanguard fund, a REIT, another RIC, a utility trust, and so on. So you want to be as detailed as possible on these supplementary schedules. Don't just clump everything together in one. And then in the additional supporting statement, so this reconciles back to Part 1. So our office expenses and filing fees, that was the revenue and expense per book. The allocation and net investment income was 0, and so we allocated it all to charitable purposes. And then the same for the legal fees. So these are just additional statements that provide more information on what we're seeing in here on these line items. All right. Okay, so I think that covers it for this tutorial. I hope that was helpful. Of course, if you have any questions, please leave me a comment below. And as always, I look forward to seeing you again on the next video. Thank you.